Hi, welcome to this discussion about break-even analysis. This is probably one of the most important concepts to understand when running your small business or any business for that matter. And unfortunately, this concept escapes a lot of people's attention. It's not as complex as most people think it is, but it's probably the most relevant calculation you can have to be able to determine what the performance needs to be of your business so that you can sustain it, maintain a profit, and also maintain the living that you want and see if it's realistic to even happen. So this is hugely important, and I go over this extensively with all of my clients, and for a lot of them, this has been a huge, tremendous help for them to be able to know, to be able to quantify how they should drive their sales revenue, to keep a really close eye on margin, to keep better books, and for the reasons that you're going to see shortly. So let's just dive in real quick. I apologize for this somewhat messy presentation. I do obviously have this in nice spreadsheet format, so if you want to reach out to me, I'm more than happy to share my spreadsheet on this and customize it for you and go over how to map it out and customize it for you and your business. So with that, let's get started here. So I'm basically doing a simple illustration using an example for a month, any given month. So you can see here, it's a profit and loss, a very basically laid out profit and loss. You probably can't read my writing too well. I apologize for that. So this is just a very, very basically laid out profit and loss statement here, okay? So we have revenue of $12,500. I'm just going to lay this out real quick. Cost of goods sold or services, $2,500, leaving a gross profit of $10,000. So what are costs of goods sold real quick for those who are not familiar with the term? Let's say you sell toothpaste, and you're buying it from a manufacturer and you're reselling it to one of your customers. That's a cost of your sale, so it's a cost of goods sold. So you're buying it from a manufacturer and you're reselling it to your customer. That will be a cost of good. So it's a directly related cost to the sale. And it's the same concept for service. So let's say you're a technology consultant or graphic design artist or some kind of personal service. You're gonna have a client engagement, and you're gonna have subcontractors, or you're gonna have specifically allocated employees to that job. So that's a directly allocated expense to the revenue you're generating for that job. So that's why it's important to understand the difference. Because if you have no revenue, you're not going to have potentially this cost. So if you're not going to sell any toothpaste for a given month, you're not going to have to buy toothpaste from the manufacturer. If you're not going to do a graphic, if you're not going to do a logo or an advertising campaign or whatnot, you may not have those subcontractors to hire for that month. So that's why it's very important to segregate out this group, as opposed to your rent, your telecommunications, your office. These are all fixed. They're fixed costs because these are the costs that no matter what kind of revenue you're generating, these are going to be with you until you close the business. So this is the hurdle you have to get over, essentially. So the break-even analysis allows us the opportunity to determine what that hurdle is to overcome, so that we can, at a minimum, break even, and at a maximum, make more than break even, and give us also some sales targets and goals to achieve. So with that, we have our gross profit margin dollar. The dollar margin is $10,000. $12,500 less $2,500 is giving us $10,000. That's 80% gross profit. Very healthy business. I don't see too many of these, but they're out there. Maybe graphic design or that kind of technology consulting might be in this category, but not probably a little unrealistic there. But very healthy. But for purposes of illustration, it works. Then we're going to have rent, 8% of total sales. So this is the percentage of total income. The percentage of this to total income. So you just got to remember that. So we see here total fixed expense. We add up these. Oop, sorry, that got a little skipped a little bit. So the net income before officer compensation is $7,800. Okay, because I didn't include wages for you in this calculation yet, and you'll understand why. So that's that. Okay. Now let's just do a quick, before we skip to this over here, we're going to do a quick break even on the 7,800. Okay. So what is the break even? How do you calculate break even? Break even is very simply the fixed cost divided by the gross profit margin. Okay, and that's going to yield $2,750 right there. Okay, and here's a little bit further breakdown of that, how that basically is calculated. Well, we know we have to basically overcome this $2,200 to break even, right? So how do we get to $2,750? Well, we have to basically sell at a minimum $687.50 worth of product or service at a cost of $137.50. That's 80%, right? I'm sorry, that's 20%. Okay, this is the 80% that we're talking about. $550 is what's left over between the revenue minus the expense. Okay? So this is 20%. So that's how we get to $2,750. So this is the profit. Okay? And this is, so you add the profit to the total fixed cost, and that's how you get the break even. So in really, really basic terms, you're just going to take your fixed cost divided by your gross profit margin percentage. Okay. So that's what it is. So in this scenario, if we're not going to make any money, we just want to, keep the business alive and meet our obligations, our basic minimum obligations, we at a minimum have to generate $2,700, $2,750 worth of revenue to break even. Now, what if? Okay, so but what if you absolutely need to generate income for yourself and you don't have savings, you don't have any, other kinds of loans or anything like that, any kind of cushion? You absolutely need to make $5,000 a month. Okay? So you have to make $5,000 a month. Well, all of a sudden, your break-even jumps to $9,000. Okay, which it's the same kind of concept here with the formula. So then in this case, you're going to do 2,200 plus 5,000 divided by 0.8. Okay, so you're just adding it to the break-even number to come up to determine what your break-even. You're adding the officer compensation to this fixed cost total to come up with the break-even number there. I apologize if it's a little bit messy. So you could see dramatically how you could adjust any one of these accounts to determine what your break-even needs to be, what your goals, and how to set your expectations for your employees, your sales team, whomever. Okay, so this is one example of a profitable business with healthy margins. So to kind of springboard a little bit off of this officer compensation, what does it mean to to keep adding on various expenses to the business? I have another illustration. Starting out with the same revenue number, but in this business, the cost of goods sold on $12,500 worth of revenue, you have $11,000 of cost to generate that $12,000 of revenue. That's 88%, leaving you with a very, very, very small margin. Very small. So you're only left with $1,500 on margin here to work with. That's basically It's not even enough to help you with your break even. So you're already at a loss. You're not even breaking even, and now let's say you also wanted to add in your minimum compensation that you're willing to take for taking the risk and being in this business. So now your net income after your compensation is $5,700. So we have the two different break-even calculations here. We have the one before your compensation, and we have the one after. Well, based on this really, really ugly margin, profit margin of 12% right there, your break-even before your compensation has to be $18,333. Okay, and we're not even close. You're only at $12,500. Your break-even after your compensation, if you want to get paid, okay, that's going to be $60,000 a month. So you can see how important it is, how these percentages can dramatically change the results of this computation. And that's why it's so important no matter what kind of business you're in. And probably more so for people that really have a lot of different variable costs. Restaurants, that's like, really popular small business. Keeping track of your margin is so crucial. Doing your menu costing, that sort of thing. How do you do all that to make sure that you're hitting your targets? So this is just a really basic example. I invite you to call me, ask me. I'm more than happy to send a spreadsheet for you, customize it for you, and walk through this with you, in a little more detail with a little bit more time on a more personal level. But thanks for watching, and give me a call if you have any questions on this. Thanks again.